This is Ken Long from Tortoise Capital Management with the Easter edition of the Daily Trading Report. And we're looking at a market that is bullish normal. On an annual basis, it's at 66 out of 100 on the weekly RSI, so slightly above the midpoint. On a 10-day basis, it's at 95 out of 100, meaning it's overbought on a short-term basis. Percent stretch above the 200-day moving average is 10.83%. That's in the white, which is bullish. The slope of the 50-day moving average is almost flat at 0.08, and that's so weak compared to the last 180 days that's coded red and bearish. ADX at 14.3 is a weak, sideways, untrending market, rated as weak. And the only good news on that one for the bull side of the trade is that this week the price action was favorable enough that plus DI is better than minus DI. ATR percentage at 0.98 is at the low end of normal, just underneath normal average right now. In the gap stat over the last 30 days, the market has been gapping up and reversing 11 times out of 30. Gapping up and continuing to go 7 times out of 30, and you can see the follow through. When it is gapped down, it has been exactly balanced between gap down and fail 6 times, or gap down and then reverse up 6 times at 0.68. That's been the best trade in terms of average follow through, as you can see, by 0.68%. So the gap down is a toss up, but if it goes up from there, it's going to be twice as good as the relative fail has been. In the gap stat, the range stat, the +1 standard deviation plus average move intraday for SPY has been 1.56%. It's come down just a little bit since last week. The biggest intraday move in the last 180 days has been 2.63. You can see on the NDX 10 time series that we've gone from oversold up to overbought, and so we should be cautious up at this range, and that's sort of the channeling pattern in action right there. No signals in overreaction or channeling. You can see the volatility curve here of SPY's ATR percentage. We had got down fairly close to quiet and have now hooked back up and are right underneath normal. The ADX, you see, has come down below 15. Plus DI has caught up to minus DI, so we're poised for a trending move from either direction here. Either you can make a case for either one of them that it can be a big move because ADX has diminished to such a low level. No real patterns to note. Everything was a improvement on the Elder Safe Zone channel. Only VXX got measurably weaker, and you can see the stealth candidates and the modified French momentum candidates. Those are sneaky symbols that are poised for longer-term gains. Quick review of the Dow tactical summary. You can see quite a few dojis on Friday. Percent winners were Alcoa, IBM, AT&T, and Travelers. Percent losers, General Electric, McDonald's, Pfizer, and Verizon. No patterns to speak of. You can Bank of America and Cisco, JP Morgan, Alcoa, and then Chevron for the max pain range compressions. I kind of like Bank of America here at number 1 on max pain range compression. You can see it's coded red from the time periods 5 days back to 12 months, but then it actually has been doing fairly well over the last 3 and then 1 day, so that could be evidence of some bottoming action. Hewlett-Packard is in the same condition here. Horrible over the 1 month and beyond, but closer in it's been doing much better, along with the rest of the techs that we saw this week. Pfizer has been, on the other hand, which it had been a fairly strong defensive sector play, but from 10 days and then closer, it's just been horrible, part of that big gap down problem. Looking at the ETF 30 tactical summary, also quite a few dojis in agriculture, Euro-Asia blend, and so forth. No patterns to speak of. The max pain range compression beginning with the VIX, and that's really just because of such a horrible run in the VIX. You can see it has made new closing lows over any measurable time period here on the Tortoise NDX. Any close 0 or below gives you an indication that it has closed below the previous look-back period's low, and then the number tells you kind of the magnitude of that. So it's closed 15% of that trading range below the previous low. That's how bad it's been. On the other hand, coal has made quite an extraordinary 3-day move and a 1-day move, and so coal ought to be on our short list for watching. And silver, you can just see. I mean, who needs to say anything more about silver? It's massively good. Natural gas at 11.54 had a great day on Friday as well. Inside the additional mosaic indicators, see the slope of their 30-day regression line slope with the R-squared at 0.48. A fairly good descriptor there, therefore, of price action. You can see on the time series here, the blue line is the slope of that, where we have gone from 2 standard deviations below the black average line. It crossed over its 10-day moving average approximately here about 15 days ago, and has been steadily improving. And as long as it's above its 10-day moving average, it's generally an upward bias. I'm looking for a breakout of 134 here. And then this is the last 180 days time series. This move from 2 standard deviations below and then above is this move zoomed in. The percent stretch still remains below 1 standard deviation above the 200, so there's room for another 8 to 10% move to the upside. Just for reference data, the range stats of typical suspects, the big ETFs, and then the Dow 30. We'll just take silver. Remains at about 3.3% intraday travel, from a low of the day to a hypothetical high of the day. Japan is still pretty strong in that regard, and the VIX, you can see, travels almost 6% on a normal day. In the safe zone channel for SPY, you can see it's made its move to the upside. These are the gap stats for a number of the usual suspects. In the quality report, I like to look for red on the 2 month ago and then improvements on the 1 month ago. So that gets me into red, then yellow. So I'm liking Microsoft, Walmart, Procter & Gamble, and Hewlett-Packard. And in the ETF 30, natural gas has been so bad that that's the only one that's coded red. But natural gas is in the wheelhouse. You can see on the divergence score that it's doing pretty well. And I also like EWZ and EEM because they were bad in yellow and then white. On the relative strength score, you can see technology has made a nice move and is pulling away from the other U.S. Indices. It moved from the weakest to the second strongest, in fact, on the ETF2 score. So as the diamonds, mid caps, and small caps have begun to fail, the technology has made a nice improvement. Commodities all kind of trending along here together, really just tracking the SPY. And then Japan has made its nice move out of the abyss. It's made a 4 to almost a 6 standard deviation move from horrible to not so horrible, and that's good news for the Japanese. In the elder safe zone channeling, basically everything got measurably stronger on Friday. And then the top 15% or top 15 winners and losers over the time periods. I'll just leave that for your reference. Pivot points calculated for all the usual suspects, plus some interesting symbols I always like to track. The holding X number of days percentage, you can see on a 10-day basis among the U.S., the 1.96% return over the last 10 days for technology was actually the best of any of the U.S. indexes. So what had been horrible has been getting better. Weakness over the last 10 days, mid caps and small caps. Correlation coefficients. You can see how far out of whack Japan has been compared to all the other indexes. And that's everything from the daily report that I want to highlight. So this is Ken Long wishing you a happy Easter. Be safe and count our blessings.